This episode is brought to you by Blockdaemon. You'll be hearing all about them later from me later in the episode, but now, on with the show. All right, everyone, welcome back to another weekly Roundup edition of On the Margin. I am joined, as always, by my usual intrepid co-host, Mr. Mark Yusko, and we've got special guest Dan Tapiero on the show. Guys, welcome to the show.
Hey, great to see you. Great to see you. And Dan, you get to experience the sock reveal real quickly. Just get out of the way. So I climb up on the chair and I show the sock. So I got the crypto winner, the cold storage. I went back and forth this morning on the RIP Bitcoin and the crypto winner. I went with crypto winner because we're there, and now we're not going to talk about crypto. We're going to talk about macro.
All right, guys. Got a lot of really interesting charts to go through. Guys, just to give you the overall rundown here, obviously the FOMC happened yesterday. There was a 75 basis point hike, and we're starting to see carnage kind of ripple out into both more general financial markets and then obviously crypto specifically. So we've got a bunch of great charts here. I want to just start by showing this was kind of an interesting visualization of Fed hikes for the past 30 years. So you can see, obviously, mostly what the Fed has been doing is cutting for the past 30 years. And there's only been one 75 basis point hike. And that's so we're entering into pretty rarefied air here. And markets are starting to respond. So Dan, why don't we kick this off here? You sent over this this chart, right? Let us know, what are we looking at here? Why did you think this was so important to talk about?
Yeah, I mean, this is the kind of charts that we used to come up with when I was managing a macro portfolio. And broadly what this says is that it's looking at a rate of change, okay, in oil and in interest rates over the last, let's just say 6 to 9 months. It's showing you, it's an index composed of market indicators that reflect a tightening in liquidity, okay? Oil price doubles, mortgage rates double, the dollar has a giant move, okay? Now, what do those things mean? How do you look at that move, that 9-month move versus similar moves in history? And what you see post-COVID, of course, is massive easing. You can see that all the way up there. And also now a destruction of liquidity that is unprecedented, going back to, what is the date there? Let's take a look.
1984.
Back to 1984. You have never had such an extreme market tightening. It's almost like you call this a monetary conditions index, a rate of change of a monetary conditions index. And this came out about 6-7 weeks ago. And look, it shows to me that basically the interest rate hikes that are priced into the markets are way beyond anything that is needed to slow growth and inflation. And maybe, Mark, I'm stealing the thunder of this conversation a little bit, but the fact that the Fed has already said they're going to do another 50, they did 75, they might do another 75, I think is going to be very, very tough for all markets, in the next sort of 3-4 month period. I would say that the Fed boxed themselves in a little bit by saying, they're going to wait for clear and obvious information that growth and inflation has dropped. And what that probably means is 3-4 months of CPI dropping, of GDP or ISM getting down to lower numbers. And the problem with that is that they're acting way after the fact. The markets have already tightened dramatically, more than ever, more than they have before, in terms of rate of change. And you can't shock a system like this. I don't care what the inflation rate is. You just can't do it. I think this is going to be seen in retrospect as dramatic policy error. And the last thing I'll say is that, this happens, over the course of the last 30 years. This has happened at times because the Fed is a board of academics. They're not market practitioners. Powell is not a macro market practitioner. He was a private equity guy. Yes, they have lots of information at their hands, 300 economists and all of that. But for whatever reason, they don't really believe the markets. They don't really trust the markets. All you have to do is sit back now. You don't need to raise rates to 4%. They say 4% is March Fed funds future. I don't think we're getting to 4. I don't think we're getting to 3. I just think the next 3 months are going to potentially be, dangerous. I'm sorry. And last thing is that there are parts of the financial markets that are already freezing up, i.e. no liquidity. Reminds me of August '07 when Bernanke said he was more concerned about inflation than he was that the market had frozen. So the market collapsed, and then Bernanke reversed into August and cut the discount rate. Unfortunately, even if the market collapses, it doesn't feel to me like we're going to get a discount rate cut. The Fed is it's taking us into sort of a diabolical area here the next few months. Okay, so let me stop.
No, diabolical is the word. Look, diabolical is the word. And I went back and forth with Steve McClurg this morning on this, and he said the unintended consequences. Mike, scratch the un. This is not unintended. This is, I believe, clear intention. This is about breaking stuff. And I'll give you an example of what Dan's talking about, Mike, on the, I just called you Mike, it's Michael. For me, it's Michael. Friday, for only the 5th time in history, mortgage-backed security market went no bid. Let that linger. No bid. There were 0 bids for mortgage-backed securitizations. None. 0. It happened once in 1994, once in 2007, and twice in 2008. And they were indicators of the global financial crisis. That chart that Dan shared, to me, shows not 1, but 2 policy errors that will go down in history, I believe, as bad as the policy errors of 1937, raising rates from 0 to 25 basis points, taking garden variety recession, turning into Great Depression, as bad as Smoot-Hawley in 31, as bad as the Fed tightening at the end of the market crash in 29. And that spike up is the problem. That's what's caused the inflation, air quotes. It's not inflation, it's currency devaluation. And now they've pulled all of that out and more. The market has. It did its job from the central bank jawboning, and things are breaking. High yield bond market, as we are sitting here recording this, is breaking. I mean, and there is going to be, I think this is 2001, 2002 all over again. Enron, WorldCom. I mean, massive companies are going to vaporize. Mm-hmm.
Yeah, just to guys, if you're listening along and not following us via video here, we've got some supporting charts here. So we're looking at the percentage premium, right? That HYG, right, which is kind of the premier high yield index for U.S. corporate debt, right? That trades at a premium or a discount to NAV, and that's falling into pretty severely negative territory. There's also the MOVE index, which is essentially, that's the creation of Harley Bassman, right? This is kind of like the VIX, but for bonds. We're looking at, pretty historic levels of spiking here. Not quite back to 2020, but this chart is 2 days old. I don't know. It might be there, as of today.
Mark, let me just ask. I'm sorry, Mike. I didn't go through every word of the Fed statement like I used to 20 years ago. Did they even mention any of the markets freezing up and anything? Did they mention any markets, anything? No, I didn't think so.
Such an important point, Dan. Such an important point.
They didn't even mention it, right?
No, and okay. It reminds me of, and you said it, right? These are not market people. I mean, the stat that I talk about all the time is the Fed, right? Which is populated by hundreds of PhD educated, like you would think, smart people, have predicted future GDP growth every quarter for however many years. It's like 268 quarters. They're over. They've never gotten it right. I mean, think about that. We could flip a coin and get it right half the time. but they've never gotten it right. And so what to your Dan's point right now, what they did yesterday by just not acknowledging any of the fires raging around us, it's literally like the ostrich. The ostrich is sitting out there minding its own business, then the lion comes out of the savannah, and the ostrich turns its back on the lion, lays its head on the sand, and pretends that the lion can't see it. The lion still eats the ostrich. The ostrich just doesn't see it happen.
They're just academics, and they're looking at lagging data. The Philly Fed dropped quite a bit. All these sort of leading indicators. We could go through some of these charts. I mean, all the leading indicators are suggesting growth that is sort of back to or worse than '08 levels. We have some other charts. I mean, the housing market, I think the next 6 to 9 months. And I put something out on Twitter a few weeks ago just to posit, it is possible that in retrospect, we get a major movement against the Fed in the next sort of 6 to 9 months. It's not today. When people realize they haven't been sensitive to market conditions, if we really do enter this air pocket where many things stop trading, you are damaging, all of these pension funds, all of the insurance companies, all the institutional money that's out there, 60-40, 70-30 allocated between equity and bonds. What we haven't said is that it's not just that equities are down a lot. Equities have had the worst start to the year. I think it's the second worst start of the last 75 years. And not only that, is that the bond market has also collapsed. And so if you're long bonds and you're long stocks, normally in years past, your bonds would help offset your losses. You've gotten double whammy. You've gotten killed. It's been the worst, period for bonds, I think in the last, certainly over 50 years. So the losses that people have, maybe they don't realize yet, they will realize. And I think people 6 months from now are going to question, what was the Fed doing? And look, I think this is an outlier. I don't really expect this, but there is a view out there, at least amongst some of the people I speak with, that, maybe a monetary policy that's guided by sort of mathematical rules, a currency that's based on, mathematical rules, can do better than, this constant human intervention. And of course, I'm referencing Bitcoin. But, things maybe have to get a lot worse for people to realize that the reliance on human intervention creates a type of volatility that I think is just too much for institutions and people to handle. That's really, and I don't care how much the market went up in the previous few years. People say, well, it's up a lot. Greenspan in '94 learned, that you can't shock a market. All right, '94, I remember like yesterday, led to Mexico blowing up in early '95.
Yep.
And what that means now to me is that we de facto are on course for a kind of blow up. And I don't know where it's going to come from, but whoever's most leveraged is, I think, going to get crushed the most. And if some people think that's in crypto, I don't think it's going to be crypto. Even if there are leverage pockets in crypto, crypto is the only market in the world that can handle volatility, right? We've had Bitcoin, the greatest returning asset over the last 12 years, over 200% annualized, with 7 drawdowns of 70%, and here we are. So we've already gotten crushed in crypto, the underlying market, some of them down between 50 and 80%. And the market is still functioning just fine, okay? People aren't thrilled with where it is. There's no discontinuity. Yes, there's less liquidity in that market today, but that market, because it's an early stage market, can handle extreme volatility and has many, many times. The other markets cannot.
No, it's such a critical point that it's about fragility. Right. And it's about reflexivity. And look, when your 401k turns into a 301k, it's a bad day. When it turns into a 201k, it's a really bad day. If it turns into a 101k, now you're done. And the average person doesn't have much savings. They don't have much margin of safety. And so this sinister plot, it's Sinister Saturday when we usually release these, and so I got to get the sinister word in there. But this sinister plot to impoverish the masses is really...
Well, Mark, come on. I don't think that, Jay Powell and those guys, I don't think that they're specifically planning to impoverish the masses. I mean, I think that they're really trying to do. They see an 8% CPI and they're panicked. Okay, this is all. They're panicked, and this is maybe they're having pressure from people. There are guys out there calling for. Some guy yesterday called for a hike to 4%. Total madness. There are people who have specific personal reasons. I see some of these older guys, the guys over 60, 65, they want maybe a crushing so that they get to buy assets cheap.
Yeah.
I don't think that's the right thing. The only thing that to me, I get a little bit is, look, there are political implications, and there's no question at the moment that the Democrats in the midterm elections are going to suffer the greatest defeat, maybe since Reagan. They're going to get completely annihilated. So if there are any Democrats listening to us here, guys, you're going to be completely annihilated because over the next 6 months, things are going to get worse. The conversation that Biden or whoever it is that's in that White House that is doing stuff should have with the Federal Reserve is, whoa, guys. But I think it's too late, to be honest. They boxed themselves in. And so the benefit is we are going to have, I think, a pretty strong Republican majority now in the Congress. And again, that should be good for capitalism and good for business down the road. So, there's no silver lining, but if you want to make one up, I think.
Yeah, look, I'm gonna take the under on the good news. We just entered this morning. We entered Bluto-Blutarskiville on GDP, 0.0.
Yeah.
Fat, drunk, and stupid is no way to go through life, son. So that is what the U.S. economy is. It's fat, drunk, and stupid. And we are now definitely in recession. That number is going to go way lower than 0.0 for Q2. And whoever's in power in DC has no shot at fixing this. It is so broken. Because, Dan, how many rate hikes are going to lower the price of oil? How many rate hikes are going to fix the wheat crop this year? How many rate hikes are going to get China to open up their ports and let the ships fill up with goods so the global trade can resume? I don't think the Fed has any. I think it has 0.0 power to affect any sort of change. I agree with you. They are panicking and they read the headlines and like, oh my God, inflation's so high. I went to dinner with my little guy who just came in and made those crazy noises. But I went to dinner with him last night after lacrosse. We had a bowl of spaghetti and a lasagna, okay, and 2 drinks. $50. $50.
Yeah, I know, but
I'm in Chapel Hill. I'm not in New York.
I know, but look, this is coming. They don't have to do anything, and the oil price is going to be significantly lower by the end of the year because there's been massive demand destruction that is in the pipeline that is baked in the cake. So my guess is typically the oil market will peak into the end of the driving season and then goodbye. And oil, I think, will be sub 100 easily by the end of the year. The amount of demand destruction and the speed at which it's coming is faster than we've seen. Probably will happen faster than 08. My job really is, and what I've done my whole career, is not talk about what is today. It's only just to talk about what's coming in the next 6 to 12 months. And this is going to be especially severe. So I'm not worried about the oil price. The wheat price, I used to be very focused on agriculture. I'm not worried about the wheat price at all. Just so that you know, I mean, the percentage of the cost of wheat that goes into the loaf of bread that you purchase at the supermarket is very small. When you go to the supermarket, you pay $3 for a loaf of bread. I think it's less than 5% of it is attributed to the price of wheat. You pay more for, the plastic bag that it's wrapped in, the guy who drops it off at the store, his insurance, the gas for his car. I mean, look, it's about oil, but they're killing, and you hear this often. They're killing the patient, i.e., the economy, to cure the sugar addiction. And there's a sugar addiction. Okay, so what you do is you slowly take the sugar addiction out. You have some faith in the forecast and in leading indicators, of which there are many. If you look at the sentiment indicators and you look at the levels of, I've showed you something from that fantastic BA Merrill Lynch fund manager survey. Here it is. Profit expectations are already lowest. What's the follow? This shows a degree of super negative sentiment. You normally get crashes from levels of extreme oversoldness. If you see 08, we were low for a while. You didn't bottom until OC 08, but it stayed low for a while. So this is not good. If you go back, there was another one, net expecting stronger economy. People not expecting a stronger economy. It's that means that there isn't sort of liquidity there to buy, the kind of weakness that we're seeing now. People are just going to stay close to home. Stan said it the other day. I read a blurb about his interview, just sitting on their hands, just like we are, at 10T. I think there's going to be fallout, and people who are leveraged are going to be in trouble, and there are going to be discounts. You're going to be able to buy equity of companies that can really grow a ton at very large discounts. And the people who are sitting on cash, who are still, making cash, are going to also, those companies are going to be acquiring some of these guys who are in trouble. So I don't know, next 6 months, I just don't, 3-4 months, I just don't see how we get out of it. The Fed's playbook has set us on course for demand destruction.
Yeah.
And I don't think the markets have even started to respond to that. Like, supposedly growth is still robust according to, the policymakers.
Janet and Jay want to tell us how strong the economy is. And that's because, weak is the new strong. It's like orange is the new black.
Well, we need things to weaken up. I mean, unfortunately, they just have to weaken up to a degree that shocks the Fed out of their current path. The one good thing that he did say yesterday, Powell, is that, the Fed will remain flexible. So remain flexible. He sees these charts, hopefully, and he's saying, okay, things are not that good now. I'll remain flexible. But I don't think you can, hang your hat on that one phrase, right? If you think this is a good place to sort of wade into the markets.
This episode is brought to you by Blockdaemon, the world's leading blockchain infrastructure platform. Blockdaemon's mission is simple: make spinning up a node so easy a 5-year-old could do it, and so secure that any chief compliance officer in the world could sleep easy at night. In plain English, Blockdaemon allows anyone, whether you're a crypto native fund, a financial institution, a DeFi protocol, whatever, to participate in crypto more safely. For some, that can mean participating in governance. It could mean gathering real-time and accurate data. It could mean generating yield through staking. Whatever it is, when it comes to crypto, infrastructure is edge, and there's simply no better edge offered than the one from Blockdaemon. Blockdaemon supports a range of services on over 50 protocols, and that's a growing list. They have multiple layers of risk mitigation that include regional and data center diversity, 24/7 human and automated monitoring, a full-service team of engineers to avoid technical difficulties, and things like slashing insurance. In other words, they literally make it foolproof. If your organization relies on real-time, accurate data that comes from blockchains, please, please, please click the link at the bottom of this episode and go check them out. Again, it's important. Gotta click the link at the bottom, otherwise I won't get my credit. Yeah. Guys, I'd be curious, we're talking a lot about the Fed. Obviously, they're the most important global central bank, but other central banks are, struggling as well, and there's some signs of stress abroad, right? So the ECB just held on Wednesday of this week, so that's yesterday is the day of recording, this emergency meeting. You're starting to see signs of stress, right? There's the benchmark, the spread between, the German benchmark and the Italian benchmark, which is blowing out, which is typically a sign of stress for them. The Bank of Japan is struggling to defend the, 25 basis point, yield curve controlled target that they've set for themselves, which I would have thought would be impossible. I think they're like 67% of the JGB market, and they have an infinite bid, but they're still struggling there as well. There have recently been surprise. I think the Swiss National Bank, they had a surprise yesterday. They did a 50 basis point hike. Australia's central bank, India's central bank tightened more than folks thought they would. This is a global thing that's going on here. I'm curious, how much do you view the importance of what's going on kind of in the U.S. bond market and stocks versus kind of globally what's happening?
Go ahead, Mark.
No, look, it is absolutely all interconnected. You see these coordinated moves right around WEF every year, and I think they all get together and they kind of go around and say, okay, whose turn in the hot seat? And somebody gets picked to be the strong currency. Because what every Western nation wants is a weak currency, because it's a beggar thy neighbor world, and we're in a race to the bottom. So the weaker your currency, the more you can sell, the more exports you can do. The euro was created to bring in as many crappy currencies to weaken the euro relative to the Deutschmark, because they needed to sell cars and machine tools and compete with Japan in places like China. So I think it is a globally mandated, and I said that's why I think it's much more sinister. I actually don't think it's unintended. I actually believe this is the only way out, right? Is when you're in such a world of hurt from a debt perspective, and you've turned capitalism into cronyism, and all the people at the top own all the companies that are making all the money, and they're getting all the contracts. It's like we just sent $40 billion to Ukraine. Guaranteed, most of that money ends up at companies where there's relationships with congressmen and senators all over the Hill. We could have used that money way better for people in the United States to go to bed hungry. So I mean, there's just so much graft, corruption, and you look what's going on in Canada with restrictions, and now certain classes of citizens are not going to be as Canadian. It all seems very interconnected to me and very wrong.
Well, I'm sort of I think that's possible, but I'm less focused on that, because I think, look, they all cut rates together. We have negative real rates everywhere, and rates have been negative in Switzerland for several years. The same in Germany. I think that they're taking a more cautious approach, because there are already indicators. If you look at German consumer confidence, which, Mike, I sent you a chart of, if you look at that, it's already collapsed, and they haven't even properly raised rates. So
Yep.
I think that they're more sensitive. Also, I was never thinking that the Fed would be this aggressive, just because they would be aware of all of the gross outstanding debt. I haven't done the math yet, but of course the cost to the U.S. government, and also to all of the debt holders out there, is significantly greater. Many people starting to talk about how much your mortgage payment is it's doubled on a strict sort of 30-year note, on a 30-year, the amount of monthly mortgage payment on a 30-year mortgage has doubled in the last year. So I don't know, and many people have floating debt out there. Many people have expected the rates to stay low, and they have leverage to the front end, actually, prime plus a rate. I just think that when you adjust up, you have to do it slowly. We learned that lesson in 94. Greenspan set the table in 95 for what I think was probably, and I say this often, the most important speech of a central banker of the last 30, 40 years. And he said in this speech in the summer of 95, there will come a time when inflation is still rising, but we will ignore it because we are sensitive to the forward indicators on growth. That sensitivity, that understanding of nuance in the middle of 95 set the table for a massive bull market over the following 5 years. You can say whatever you want about the bubble in 99 and the sell-off afterwards. That's a different matter. But from 87 to 94, it was very slow growth. The U.S. real estate in 93, 94 sector had been completely crushed.
Yep.
And basically, that shift in understanding, Greenspan, who had done the work himself back then, the guy used to, between 4 and 6 a.m., sit in a bathtub looking over economic data. He had his own view about the future. Okay, this guy, this Fed, does not have their own view about the future. It looks to me like he's following some mid-level economists' opinions about like what's happening today / being pressured by whoever it is to get inflation under control, instead of understanding what Greenspan understood in the middle of 95, which is that the market, okay, in end of 93 to 94 had already tightened enough. He didn't need to keep tightening, right? And then there was a blow up in Mexico that guaranteed a massive slowdown in inflation. All right. So, is Powell waiting for the blow up? I don't even know, but he's going to get one somewhere. And It's not going to be crypto, if we could just adjust to that, because crypto has blown up many times. It blows up every 18 months. People talk about, it's going to be there. There might be a liquidity run. You might have certain people go under. But, that's what happens when you're over leveraged. Anyone that's 100 times leveraged or whatever it is, and they're all going to blow up. Crypto, Bitcoin, Ethereum. This is the only asset class I've ever seen where you absolutely do not need any leverage to become, crazy wealthy. Okay. And so people who have overstepped themselves and leveraged up, they're going to go away. And, and the system, the crypto system, the digital asset ecosystem is going to absorb it just fine. And I actually think that as the old world contracts, you'll have liquidity leaving that world as the alpha opportunities, I think, continue to drop. And as the old world becomes increasingly volatile, you can't rely on a Fed that, is not really, I think, doing the right things. Why would you have all your assets in a place that is managed by a group of academics who aren't really, in tune with the financial markets? And so I think that this whole negative event for the old world ends up over the next year, 2 years, being very positive for the crypto world. So it's just my view. I know people won't agree with that, but I definitely see a transition.
Yeah.
So I made the transition for you here, Mark. I don't know if you want to comment about, we both have exposure to different companies in the space. I don't have any venture. I think the funding on the venture side in crypto, you're not going to see 50 times revenue fundings anymore. We invest largely in mid to late stage companies, and most of our companies are pretty cashed up. We might have one or two that get in trouble just because that's the nature of things out of our 18 investments. But a lot of these guys are still making money, still doing, I think, quite well. I worry a little more about the venture side where there is no revenue. But Mark, you would have a better, closer eye on that than I do.
Yeah, I mean, a couple of things. I mean, one, venture capital activity is cyclical, right? And it makes sense. In the ebullient times, money is plentiful. People flock to invest because they're looking at the past returns, and lots of funds get raised and valuations rise. Founders start businesses. Some maybe have marginal product market fit, or they're not great at execution. The period Dan talked about, 95 to '00, was amazing. 10,000 companies got formed. 10,000. I mean, it's mind-numbing to think that many companies got formed over a 5-year period. And I used to say all the time, there are not 10,000 good management teams. Just full stop.
Yeah.
There just aren't.
That's for
right?
sure.
And so what happened? Over the next 3 years, 7,000 of them went away. 7,000 companies went away. Okay. The other 3,000, some went public, some did great, some got bought. Amazon went down 94%, but then survived and thrived. But what's interesting about that is, in that dislocation, where those 7,000 companies are going out of business, people are getting laid off, lose their jobs, people do some amazing things. And they're forced, right? They don't have a choice. They got to pay the mortgage. They got to, buy food for their families. And so they're like, hey, I'm going to go start something of my own. And some of the best investments I've ever made in my career came in the teeth of the winter and the bear market and the downturn. And the problem with that is it's incredibly hard to raise money then. So there's a perfect inverse relation between ease of raising money and quality of investment opportunity. When it's super easy, when people are just throwing money at you, we all make investments that we probably should have been a little tougher on. When things are tight, oh man, there's just so many incredible opportunities, teams getting dislocated. Back to the 93 example, I remember this like it was yesterday. There was bad recession, real estate was collapsing, and there was this little company, not even a company, it was a little project inside Bell Labs called dense wave multiplexing. And this guy got laid off, literally got fired. And he said, I want to take my project with me. And they're like, yeah, whatever. Dense wave multiplexing, what the hell is that? Well, that's where you shine light through a prism, break it into colors, and each color transmits the same amount of data as white light. Pretty amazing. A company called Sienna. And, we invested in this little company, and us and the only venture capitalist that would invest in his seed round was no one. So he literally got funding from his retired third grade school teacher, who put in $300K, all her life savings, turned in $300 million. I love that part. But we and a few others finally invested, and turned out to be this amazingly great company. 2001 downturn, we invested in a startup airline. You can't start an airline in a downturn, in a recession. JetBlue turned out pretty well. And I think right now, I was talking to a CEO this morning in London. Amazing business opportunity. Valuation just got cut in half. Really good team, really good. So I'm with Dan that there'll be fewer great opportunities, but they'll be really, really great.
Well, let me say one thing. I mean, 70% you said survived. I forgot that number. But look, there are 15,000 cryptocurrencies. 99% probably are going to zero.
100%.
But that will, 99%.
I mean, 100% agree with you that 90-something percent are going to zero.
That still leaves, 100 cryptocurrencies. And even that, is to, I don't know that, that certainly I won't be able to tell you which ones.
Well, the slight difference, Dan, is that tokens, right? Utility tokens in particular are pre-seed stage crowdsourced venture capital.
Right. Exactly.
Right? With the negative that you don't get equity, you don't get debt, and you don't get a claim on cash flow. So It's a really bad structure. So the vast majority of those, look, pre-seed stage venture has a 97, 98% loss ratio to start. Okay. And everyone talks about the winners, like, oh, Steve Jobs started in his garage.
Or Solana, look, was $1 last January, went to $2.50. It's still at 35. So people are saying Solana is still up 35 times from 18 months ago. 35 times. Like,
yes.
I didn't look at it where it is today, but I mean, and could that go down to 10? I mean, why not? It's at 31 today. It still would be up 10 times, right? Ethereum was, is at 1,200, right? It last, 18 months ago was at 300 or 500. Like, things are still up a lot. I understand people buy stuff at the wrong prices. People paid 50 to 80 times for many different companies in the space that we looked at. Last year, I passed on over 100 companies.
Right.
I was not willing to pay 30 to 100 times for, all the names, Alchemy and Fireblocks and Blockdaemon, and these are great companies. These companies I think are going to be around. I can go on, FTX, but paying those multiples was nutty, and we passed. And I know that
so many.
Mark, I know you passed on a lot of stuff also, and so am I happy to see the valuations of some of these quality companies come in? If they're going to go from 70 times revenue to 10 times revenue, that's fantastic. We didn't pay more than 10 to 12 times revenue for any of the businesses that we bought, all 18 of them. Will some of them go down? It's possible. But I'm going to we're in a position now over the next 6 months to really buy distressed, discounted stock of the companies that we liked before, but that we just couldn't buy. And, I think what we're starting to see is, and I transition to this a little bit to get back into the crypto, is that, look, with Celsius coming undone and now Three Arrows, I think is a zero from, don't quote me on that, but that's the talk out there. Mike Novogratz just said a few days ago, 70% of crypto hedge funds are going to go under. Okay, they see a lot of flow at Galaxy. He doesn't throw that kind of number out there casually. I think that's right. And my thought about this, Mark, is that a liquid strategy for VC investments is absolutely the worst possible strategy out there. If you want to participate in the long-term growth that's happening in this world, right? You need to hold for 5 to 10 years, right? If you have monthly or quarterly liquidity in your fund and you're long tokens or long venture equity, I think, honestly, you're done.
Done.
You agree? I hate to be so aggressive, but 30 years in money management, I understand, the kinds of guys and funds over those years that have gotten into trouble, a mismatch between your assets and your liabilities. Right? Your investors who are expecting you to make a zillion %, right? Because maybe you're up 1,000% last year, and I've heard already of some venture funds down 70, 80%. Maybe you're still up from when you got in, maybe not if you got in at the wrong time, but that is not a viable business model. And I have to say, the reason I structured 10T the way I have, which is 10-year lockup in more developed companies in the space, is because, only because it's only those companies that I think are able to withstand that volatility, and only that private equity long-term structure that can gain the benefits and sit through the volatility. Do you want to comment on that?
If I could just sum up the situation here, guys, and give one caveat. These are unfolding situations right now, right? Celsius, Three Arrows Capital, guys.
We have no idea, basically.
Right? And I just want to caveat and say nobody has any idea, right? Because public information hasn't really been released. So I just want to firmly say everything from here on out.
We know there's fire.
We're entering the realm of speculation, but we do know.
But I think what is not speculation is that there will be quite a few liquid crypto hedge funds that go under.
Right.
So I think that I don't know who they're going to be, but I think for sure that will happen. I don't know, Mark. I should stop there.
No, look, I think part of the problem is, in many cases, it reminds, everyone uses the analogy, like Novogratz yesterday said, oh, it reminds me of long-term capital. I don't know, kind of, not really. I mean, long-term capital was they applied too much. No, it is exactly like long-term capital in that long-term capital was sunk not because they had bad strategies, but they had a mismatch of their assets and their liabilities. They used leverage that makes sense for convergence trading, right? We know with absolute certainty that in 365 days, a 30-year bond becomes a 29-year bond and the price falls 5 basis points. That is absolutely certain. You go from on the run to off the run. You can lever that up as much as you want, as long as you can hold it for 365 days without getting stopped out, you are good. 40 times leverage and merger arb, bad plan. Bad plan. And that's what sunk long-term capital. So that part I don't disagree with, when genius failed right there. And look, I didn't get to take it with me. I wish I did. But I actually had a copy of the original what they call it, the Enron partnership. When Fast
we talked
Out
about
came
this.
out,
Right.
Fast Out came out and he handed out this pitch deck. He came to Chapel Hill, North Carolina, and we met and we saved it, and we never did. We're like, this doesn't make sense to us. And I wish I would have been able to take it with me, but it's in a file drawer somewhere at University of North Carolina, and one for the history books. But I think this period right now is very much about leverage and the abuse of leverage and the misunderstanding of leverage. But I was going to say it's kind of like when people used to call Bernie Madoff a hedge fund problem. 2 problems.
No, that
hedge.
was a direct fraud.
No hedge and no fund, Dan. There was no hedge. There was no fund.
He was not a money manager.
13
the
years.
whole thing was fraud. He
had not made a trade in 13 years, right? He would just transfer money from people's account to his account. So total fraud, not a hedge fund. But people wanted you to believe it was a hedge fund because they didn't like hedge funds. So the problem with the hedge funds, in air quotes, right now in crypto, we've done this work, right? There were 600-ish, okay? Only about 50, give or take, round numbers, were above $40 million in AUM.
Wait, Mark, didn't Mike say there were Novo saying 1,900 hedge funds out there in crypto?
Again, I think that number
I have no idea what the number is.
Went up.
If I could add to that, there are a lot of hedge funds, and that's literally single individual people who have made like $5 or $10 million, and they technically register themselves as a hedge fund. So is that last time?
So what it was literally, and so let's call it 1,900. Used to be 600, but whatever the number is, and so many, 70, 80% of them were, and literally this true story. Guy bought some drugs on Silk Road, never sold the Bitcoin. It went up a gazillion %. He made $5 million. His friend said, "Hey, do that for me." Well, it turns out there was no Silk Road. He couldn't do that again. So he tried to become a fund manager, turned the 5 into 2 in the last downturn, kind of stuck with it. And then it went back up to 3.5. And that's called a hedge fund. That's not a hedge fund. That's just some guy got lucky.
I think, guys, we've forgotten to talk about something very, very important here. What I think could be the best performing asset of the next 6 to 12 months, that is gold. And again, I have a gold background, and people who listen to me in the last 3 years, I'm a Bitcoin plus gold guy. I think this is a type of scenario where we could see gold go up and make new highs, certainly up to 2,300 to 2,500. Last year, it was the single most hated asset. It gave people a little bit of love this year and did what gold always does, which is just as people were getting excited about it at around 1950, it collapsed again. But this is the kind of environment where gold will start to sniff out before everyone that the Fed is done. And it's not today, it's not next month, it's not 2 months from now. But when we see that ISM, as Raul likes to talk about, below 50, I don't know when that happens, or we have a 10-point drop in that, or we have a drop in the CPI from 8.7 to 6.2 in 1 month because things have completely vaporized. okay, gold will be there beforehand. So if you want to know when things will turn, equity, crypto, it's going to be gold first. Watch the gold. No one's long. Everyone hates it. I think it is the only, and I've been saying this for 5 years, the only true hedge to the assets in the legacy system. So I don't think Bitcoin is a hedge. Bitcoin is its own thing. I don't think Bitcoin is an inflation hedge either. That whole narrative is silly. Bitcoin is Bitcoin is a hedge to fiat debasement. Okay, and that's what's going to happen again in after this period of trouble that we're going to have over the next 3, 4, 5 months. Because, and I have a feeling, we're entering a 2, 3, 4, 5 year period of extreme volatility where the Fed overcompensates now with being too aggressive, and then 6 months from now, 9 months from now, is going to overcompensate the other way, being too easy again. And why? Because this is the nature of humans, to panic and to have fear. I mean, look, it took me 15 years at least before I didn't have panic or fear when I was losing huge amounts of money. Okay, it took me 15 years to not feel ebullient when I had just made zillions of dollars, right? And it takes a long time. And this world, it's not for civilians. I'm just telling you this. Guys like me and Mark, and certainly me, was on the front lines working for some of the most aggressive, smartest, best performing guys who have ever lived in this world, okay? And it still takes 15 years to be able to manage yourself, to be able to be calm and rational in these extreme moments. So I'm just saying, the Federal Reserve people who are not market practitioners, who do feel pressure and emotion and, all have political things as well, political pressure. I just think, they're going to overcompensate. And I'll go out on a limb a little bit and say that at some point next year, we're actually going to see them buying treasury bonds again. QE or whatever you want to call it.
Yeah. Definitely. Absolutely.
It's just the nature of humanity. And that's, again, one of the brilliant things about Bitcoin, and why I've said many times that I think it's one of the most important inventions of the last, 50 to 80 years, maybe the most important financial innovation in, who knows how long. And again, everything to me outside of Bitcoin and Ethereum are venture projects. Okay, I don't have the skill set. I'm not Andreessen, or Polychain or any of these guys who have all these computer, coders, etc., who can figure out which chain is going to survive. I can't do that. But those are all venture projects. Those people will make a lot of money if they're right. We just don't know about that. And so the volatility that the traditional world is now going to have, of course, gets amplified in the crypto world because such a big chunk of it is early stage pre-seed, like Mark said, super, highly volatile, but of course, with the greatest possibility of return.
Right. I've got a question for you, actually. I'd like both your opinions on this. So maybe one of those guys that I know you've worked with in the past, Dan, Stan Druckenmiller, recently did. John Collison interviewed him. It was a great interview. I highly recommend everyone listen to it. We can drop the link in the show notes. The way he described the difference between Bitcoin and gold, right, is they're kind of two sides of the same trade, so to speak, right? They're both kind of a central bank, currency debasement. But in a bear market, you want to own gold. In a bull market, you want to own Bitcoin. I'd be curious, A, if you probably listened to that, if I'm summing that up correctly, and B, sort of what you think about that thesis that he laid out.
Well, I work with Stan, and he's very rarely wrong. He's always very humble when he speaks publicly. But the reality is that when he comes out and says something publicly, his hit ratio of being right is very high. And, I saw that as well, of course. working with him. I think that that's probably right. I would hate to, have to stick to that specifically, because there are lots of periods in between when we're not in a bull or in a clear bull or bear, where we have consolidations. But I mean, like broadly, if you had to step back, you could say that that was right. I don't know that that will always be right, because I think that Bitcoin is something much bigger than gold. Gold to me is a hedge, as I said, for your assets in your traditional portfolio. Bitcoin in Ethereum, Bitcoin is programmable money. This is different. Gold is not programmable money. I think the world of NFTs, which just kicked off, is in the first batter of the first inning, is a huge innovation. So all the different innovations coming off of Satoshi's white paper and Bitcoin just make it to me much more. There's a part that's the technical innovation injected into money is much bigger than just gold. But from a trading perspective, I mean, Stan, as I said, very rarely wrong.
Yeah, but here's the thing.
Right.
Gold is the only asset that has commodity and currency characteristics, right? Everything else, you're either commodity or a currency. But gold, for 5,000 years, it's the only money. It's the only asset that exists in the absence of a liability. Now we have Bitcoin too, but for 5,000 years, it's the only money in the world. And what's interesting, over the last 2 years, right, since the Fed went on their crazy money printing binge on the cult of Kelton advice, which is going to go down again. If the current policy mistakes go down as some of the worst ever, the people that listen to Stephanie Kelton will go down as the biggest idiots, I think, in the history of economics. So the cult of Kelton led to money supply expanding by roughly 50%, 50, over a 2-year period, right? 256 years of the Republic, half the money ever created in those 256 years happened in 2 years. Guess what gold's done over the last 2 years? Up 45%. Perfect money store of value, right? Basically, you devalued the currency by 50%, gold goes up. Interestingly, Bitcoin over the same period is up twice as much. It's up 100%. Now, why is that? Well, it's more liquid. It's got a greater, I'll call it trader clientele in the free float, right? If you think about boomer rocks versus digital gold, I talk about digital divide, right? Ask anyone over 35, who's your broker? Merrill Lynch, UBS, whoever. How much gold do you have? 3-4%. How much Bitcoin do you have? Zero. It's a Ponzi scheme. Haven't you ever listened to Peter Schiff? How often do you use DeFi? What the hell's DeFi? Ask anyone under 35, who's your broker? What's a broker? I mean, I got a Robinhood account. How much gold do you have? Are you kidding me? Boomer rocks? Haven't you heard that guy Schiff? How much Bitcoin do you have? I don't want to talk about it. Why not? Because it's like a really big percentage of my net worth. I'm a little embarrassed. Okay? How often do you use DeFi? Every day. So there's just a divide. And so I agree with Dan, right? There's no question the Fed's going to have to reverse course. There's no question they're going to have to print money, just like Japan has had to print money.
Yeah, but it's unfortunate that we have to get to this, because I think a more, what is the answer? People will be like, okay, it's a more nuanced understanding of the future. And, the Fed is a risk averse entity, and they're not willing to take risk to believe that the markets have already destroyed enough liquidity that they don't need to be as aggressive here. And again, I referenced Greenspan in 95. I think he'd realized that he'd over tightened a little bit in 94, blew something up, and inflation was still going up, and said, look, guys, it's over. He also recognized it a little too late, but maybe that's just where we're going, is that they have to see something blow up. Something has to give.
But it is blowing, and this is the problem. It is blowing up. And I got
it is. It's already. Guys, it's a good point.
With these guys today, they're like, "Oh, look, the world's still spinning," and like, Are you
Mark, your
kidding me?
point in the beginning, I want to stress this, that the mortgage-backed security market was no bid last week. That's all you have to know. The same thing happened in August '07. That's all you have to know. There's not enough liquidity out there. How do you know that? Because one of the most liquid markets in the world, there's no bid. I think Bitcoin and Ethereum have traded actually, incredibly well without discontinuity.
Totally agree.
But they're so used to this. I don't,
But here's the problem. I hear these people talk about, oh, well, the dollar's still strong. I'm like, are you kidding me? The dollar's not strong. It's just that the euro and the yen, I mean, one of the great trades of the last 10 years was being short yen over the last year. I mean, it's just gotten absolutely
Smoke.
clobbered. And yet bonds, right? The ag index is down 14%. High yield bonds down another 2% today, now down 17 for the year. Long bonds down 30%. Okay. Equities, regular equities down 6% now after today. Tech stocks down almost 40. I mean, we're talking half of the tech wreck in 2001, 2002, and we might just be getting warmed up.
It's also the speed. That's the problem. Is this has happened. All you have to look at is the stock market has had. Is it the worst start to the year, or the second or third worst start to the year ever? Okay, that's enough. Yes, I know it went up a lot the last 2 years, but that doesn't matter. Things, people. It's not symmetric. People feel much worse, on a drop that way. If you had a 40% drop over 3 years, that's different. It happened in a matter of months. It's happening in a matter of months. And the markets move faster than people in economic data adjust. And that's really, that's what macro guys, that's what macro guys have focused on and traded for years and years.
Yeah.
Right? Reading the clues of the markets and guessing what that will mean about data coming in the future and being ahead of the central banks.
Well, and Dan said something that I want to make sure everybody listens and rewind the tape and rewind the podcast and listen to it again. Dan and I are the OMG. I mean, old. He doesn't look as old as I do, but we're old, right? OMG.
Neither one of you look very.
And he just looks so good. But it's just amazing, and it's like just pisses me off. But the key is that it just means we've seen stuff and we're not dead, right? Because that which doesn't kill you makes you stronger, and you learn from it, and you figure out how to weather the next storm. But he said something earlier about the job of being a macro investor is not about looking at the past and saying, oh yeah, that happened or happened past tense. It's what's going to happen 6 months out. And the ability to imagine the unimaginable and to see around corners and to actually intuit as opposed to just stare at a screen all day and analyze current data is really, really important. And it's what separates the greats that Dan was fortunate enough to work at their elbow. It's literally like being able to paint right next to Picasso, right? You would become a better painter if you stood next to Picasso and copied his brushstrokes. And eventually you got to paint your own stuff, but you would become a better painter if you're around greatness. And so the cool thing about the internet is greatness is all around us. There are people who put out stuff for free, like we are right now, that is worth a lot of money. Not because we're great, but just that we have studied
20 years ago,
some of the greatest people.
20 years ago, you couldn't. There was no, there was no Twitter. There was no, the podcast universe was not really serious. You're right, Mark. It's all out there. Even guys like Stan out there at key moments. Just the proliferation of information and ideas.
I mean, Jim Chanos has a Twitter account. You can actually follow one of the greatest short sellers of all time, or Mark Cahodes. I mean, these guys have really amazing insights, and they're out there. Dan's out there. I mean, there are real people who will share. And it's the thing that I like is it's instant curation, because the real problem today is there's just too much. and what to focus on, other than watching On the Margin every week, which you should.
We do it for you. Guys, I've got a question because I totally agree with you. And actually, I've got two of the greats online with me. So I want to extract some of this from both of your brains and just ask you a question. So honestly, the line in that Druck interview that stood out to me was my 45 years as a CIO, I've never lived through a situation to which there is no historical analog, meaning that this next period of time, right, is pretty much unlike anything that we've seen in history. So basically, what I love to, and you use this phrase, a more nuanced version of the future, Dan. Guys, like, what's your sort of, if you had to do like a base case for what happens, are we entering some sort of, you hear a lot of like 1929 that we're going to live through a depression, or is the Fed going to pivot in 6 months and it's going to be QE again, like you guys were saying before, and then we just reset to a higher level of secular inflation and assets kind of adjust to that? Like, what's your sort of working
Look,
view
I think that the inflation, this maniacal focus on 2%, 3% for the last 30 years, I thought for years and years was too low. It was in response to the 70s. All of the Fed people, academics, everything that they did, was in response to not living through the 70s because the U.S. had a lost decade culturally. And so we lost a whole group of, people who were not employed, tremendous volatility, and they saw inflation as the boogeyman. Volcker was held up as the great guy. No historical analog just means that there's no period exactly the same as what we're going through today, but it rhymes with many, many different periods. And I would say that maybe part of the interesting part, if you look into the future, is that there's no historical analog potentially because we are going to have this shift into the digital asset ecosystem. So I would take the next step beyond that. I know Stan is not that, I don't know anything, but I don't think he's that focused on Bitcoin or the DAE, digital asset ecosystem. I do see a transfer of wealth and money from the old world to the new world. I do think, that, that's a world, probably the only sort of truly, and I've said this before, truly functioning free market in the world. There's not been any intervention in the crypto markets, and it's had much more volatility. It's survived, anti-fragile, super robust. I know it's down. I know it's lost $1 trillion, whatever it is. It lose another 300-400 billion. It's going to be fine. Okay, that is not the case with the old world. The old world is breaking right now. And if the Fed doesn't respond to true breakage, which unfortunately I think we might see in the next few months, then we do enter a sort of more diabolical long-term, stagnation. I don't think that's going to happen. I just don't. They've been responsible before. Powell said he'll be flexible. We've all lived, guys our age, and Powell's older, but we've all lived through, a handful of long-term capital managements, liquidity crises. You had we've lived through it already. There is a playbook to that. And The only thing is, I think what Stan's suggesting is that if we do get a collapse and there is an event and they come in and do QE, again, it might lead to a greater level of inflation than we've known in the past. Mike, as you said, we might reset to a higher level, which in my view is healthy. I think a 2% CPI is too low. That is not in equilibrium, right? We got down to 2, and I think, what did it do over the last 30 years? It negative interest rates in Germany for 10 years, negative rates in Japan and Switzerland for 10 years, negative real interest rates everywhere. The 2% focus is what partially caused the deflationary undertow that we've lived in the last 20, 30 years. To me, 3, 4, 5%, not so crazy, really, and not that damaging. And I think actually given the level of debt that we have outstanding, and by the way, it's not going to impact the dollar that much, just because I think, I think other places, dollar is only dollar versus other currencies will also be doing the same thing. So
yeah, I'm gonna take the other side. Look,
two
two people always have the same opinion. One is unnecessary. and Dan and I are friends. We think alike. But and this is not against Dan. It's just I have a much less sanguine view of where we're headed, and I'm not wishing for it. It's like I did a tweet the other day, last Thursday, that the longer, and we talked about this on the margin the last 2 weeks, the longer we stayed at that 30,000 level, there was a big risk, a real risk, that we were going to break through it like November 2018 and drop to 15K. And I put that out there on Twitter, and people were like, "You're a fucking idiot. We hate you." I'm sorry. It's not. I'm not wishing for it. I'm not even predicting it. I'm just telling you that.
Yeah, but at this point, like another 5,000 points. I mean, again,
no, that doesn't matter. No, but my point is that's a generational buying opportunity. But my point here is, I believe that there is a reason for the deflationary world that we're living in. It's demographics and debt. Too bad demographics, too many old people, plus excess debt equals deflation, the killer Ds. And we are in a 90-year cycle. We've always been in a 90-year cycle. There was a depression in the 1840s. There was a depression in the 1930s. And unfortunately, there's going to be a depression in the 2020s. And I don't like saying it. I'm not wishing for it. I don't want it to happen. But there is no government agency powerful enough to stop it because of all the policy errors that lead to it. But more importantly, the demographic and the debt problems that cause these deflationary busts.
Okay, well,
and what it means is you need crypto more than ever. You need Bitcoin more than ever to preserve your wealth from what's coming. And look, the greatest fortunes in America were created in the Great Depression, right? If you had liquidity. So what you want to have is a lot of cash, like real cash, like cash, and gold. Gold is good too. Although I think gold's going to continue to be spoofed by JP Morgan because it's very profitable for them. So I would rather own Bitcoin and cash. But look, I'm not wishing for it. I don't want it to happen, but I believe history rhymes.
Guys, one more small question here. I know we're running super low on time. On the one hand, I hear what you're saying, Mark. It seemed every indicator, right, is that we've got more pain to go. On the other hand, right, and I was wrong. I actually want to put my hand up and say I was wrong a couple months ago when I was like, we didn't get the same blow off top. Maybe we don't deserve the same pain candle on the other side. Obviously, we deserved it. So I could be wrong about this too. But, when I'm just looking at this, right, it's like every sign that you'd also want on a bottom side, right? You've got magazine covers, you've got bears doing victory dances, you've got forced liquidations, you've got layoffs, bankruptcies. It's like everything that you'd want to see.
But this is more of a short-term comment. Like, could we be in the zone of a short-term bottom where we rally for a month or two because there's some shift? Or let's say we get a dramatic drop in next month's CPI, or we get a bigger drop in the growth data. You could have a big relief rally short-term. I think that that's very possible. I've got 3 or 4 indicators that are, that on Bitcoin, that when you bought at these indicators, at these moments, you've had a tremendous run. And so I think that's very possible. There is an extreme in bear sentiment and in positioning. You're going to get some liquidations. People are getting fired. Yes, absolutely. But I still think as long as the Fed has that posture of, we're definitely doing another 50, 75, and then there's more after that. To me, that's the disconnect between the underlying fundamentals. So until they just stop, and then we have to we're going to eventually try to discount the slower growth, right? And so that, the market hasn't gotten to that yet. So I think short term, you're absolutely right. Today, in the next week, is it very possible next 2 weeks? I do think that I wouldn't be selling.
Go back and look, Michael. Here's your homework assignment, and for everybody listening, go back and read the headlines from summer of 2001. After we had the downturn in Q1, and everybody's like, "Oh, that's a blip. Everything's going to be fine," and then read about WorldCom, read about Enron, read about the breakage. 2021 was not the bad year. 2001 was not the bad year. That was only down 14. 2002 was the bad year.
Yeah.
That's when the breakage happens. And as I said, that was a garden variety recession. We could, I'm not saying we will, but we could, if the policy errors are as bad as Dan says they are, which I agree, we could have the 90-year cycle and then start reading the headline, start reading the newspapers from the 1930s, sadly.
But by the way, I mean, just to end this call, I do think if you're buying Bitcoin from 20 down to 15 or wherever it ends up going, if you're buying, a 10% position every month for the next 6 months, you'll come back 3, 4, 5 years, and you'll have made multiples on your money. And so Mark called it a generational buying opportunity. I think that's probably right. So,
right there. Just do that. Just do that.
And I don't think
do it all at once. Do like Dan said. Do it over 6 months.
Yeah, I think that's right. But to be fair to people who would say things against that, I thought that at 30,000, and I still believe that at 40,000. I think this is an asset you must have a long-term view on, and you must purchase over a certain amount of time. You don't go in all in once. You do it over a year or two or whatever it is, and you need a 10-year view. You need 8 to 10, and you will make money on your purchase.
Winter's half over. We're past the solstice. Winter's half over. We can see spring in the future, but it's in the future. All right, Michael.
Guys, I've got to run too. Guys, thank you so much for this. All right, take care.